Hi, this is Drew Tignanelli. This is our October update here with Michael P. McCarthy, CEO of the Financial Consulate, and an interesting day here in Florida as I tape this, Mikey. You know, it's they say Ian's going to come in, and we'll see what Ian has to do or has to say. You know, where I am, we should have a windy, rainy, bad wind and rain sometime tomorrow. But all in all, it should just be a tropical depression, 40, 30, 40, 50 mile hour winds. Doesn't mean that you should assume that that's not dangerous, but that's what we're going to deal with. But by the time our clients get this, it'll be, you know, it'll be tomorrow, as they say. Anyway, so we're here, you know, and the markets have been really persistently down the last few days. We're taping this on September 28th, and you've had like 6, 7, 8% decline in the markets, you know, and it really, you know, our mission is to help lessen the worry and burden of money management. And when you get these markets, we just can't fulfill our mission when you don't have bond markets to use for cover, you don't have stock markets to use for cover. And, you know, and then clients say, well, you should just sell me out altogether. But that's usually the wrong answer, Mike. It's, you know, the answer is better that we sit, and as we get good market moves like we had in August, you know, we take advantage of them. And you saw us make some changes where we don't lose the upside potential of either the stock or the bond market, but we position the portfolio to try to minimize some of that volatility, because the worst thing that can happen is too much volatility creates angst in individuals, and then they call you up and say they want you to sell out of the market totally, locking all those losses in. And, you know, it's not a loss. If I have a stock that goes from 20 to 8 and then it goes back to 30 again, that 20 to 8 move didn't mean that I lost money, right? It just means that there was a period of time it declined, and that later it rebounded and went to 30, you know, and I made $10 when I sold it. It's what you do when you sell it that matters, not what happens in the beginning.
If you often look at the bottom of the market, the days following the market bottom is generally the highest move back upwards.
Oh, yeah.
So the risk of missing that is significant, you know, but we did adjust portfolios. We took a little risk off the table. We took advantage of higher interest rates and put some money into money markets in certain portfolios.
Yeah. Well, you know, just give you a story, you know, Warren Buffett back in the 1970s was piling into Geico Insurance Company, and he was buying it at like $10, $8, $6, $5, $4. You know, the people who say, I lost 50% of my money buying Geico at 10, 6, 5. I lost 50% of my money. You know, you're going to make mistakes when you think like that. You have to understand, well, what do I own and why do I believe it's going to be worth more than what I'm paying for it? And what we own, Mike, is we own the biggest companies in the world in our international funds. We own the biggest companies in the world of the US in our US funds. We own some of the most creative companies in the US. We own a diversified pool of these things. Unless we feel that this is the end, the world's coming to an end, I'm believing that markets are going to be higher 2-3 years down the road.
Right. So some of the things that clients ask about or talk about is, you know, what's causing the markets to have, you know, such negative returns and the such. And a big part of it would be the Federal Reserve. Would you agree, Drew?
The Federal Reserve is everything. Everybody who sits there and tells me it's because of Biden or the Democrats or whatever are the same or you know, are the opposite people who during the Obama or the Jimmy Carter years always said that it was, I'm sorry, during the Bush years or whatever, that it was Bush who caused the market to go down so much. Politics, if you think about politics and make economic decisions based on your politics, you're going to make a mistake. It's the Federal Reserve. They're the ones that move markets up and down. And you go back and look at charts of when the Federal Reserve starts to move negatively or positively, and you will see a correlation in the stock market. It's not absolute, but it is clearer than you could ever make with politicians making decisions this way or that way.
So in the past month since our last video, the Federal Reserve has raised rates another 0.75% in their efforts to curb inflation. And though they're starting to actually have some success in curbing inflation, right now, as we're shooting this, expectations are that come December, they're looking to raise rates another 50 basis points, which would take our rates to about 4.25% and 4.5%. But well, as we said, they've had some success. The trailing inflation number is right now at 8.3%, and that is slightly better than the high that we hit of 9.1% in June. And we're seeing some other positive indicators on inflation. Housing prices have for the first time in a long time fallen slightly. They were up about 18% year over year, and also in June, and now they're down to 15.8% increase year over year.
If you look at the inflation expectations of, so there are these bonds, Mike, that are called inflation protected securities. And those inflation protected securities kind of give you a investor's prediction of what inflation is going to do over the next 2 or 3 years. And those inflation protected securities are only showing about a 2.5% inflation expectation over the next 2 or 3 years. And they tend to be far more accurate than anything else there is to look at for the expectations of inflation. So, you just had the perfect inflation storm with the pandemic and all the stupid money that was thrown out at the economy between the Trump administration and the Biden administration. They just threw tons of money at the economy. And now the Federal Reserve has to sop it back up in order to bring the inflation rate back into line. And, who knows how this thing's going to play out? I don't know, but sooner or later, we're going to see another side. We're going to see the other side of this. And when it happens, like you say, you miss those first few days and you're missing a major market move.
Right. Absolutely.
So let's get into some planning topics. Number one, most irritating thing that a client can do to Drew, this is to Drew, Mike, is show me that you have 50,000, 100,000, 200,000 sitting in a brick and mortar bank savings account, paying you 0.01%. That means if you have $100,000, Mike, they're going to give you $10 for the year. $10, $100,000. They're going to give you $10. Well, right now, the online savings account banks, FDIC insured banks, just like your brick and mortar bank, Ally Bank, Marcus Bank, CIT, Discover Bank, American Express, Capital One 360. These online banks are now yielding well over 2% now. 2%. That means you're going to get $2,000 of interest on $100,000 invested. And you know what? Because the Federal Reserve is raising rates, these online banks won't stop. They'll be going to 3. Yeah. They'll be, I'll bet you we could
every couple of weeks saying that we've increased your rate.
Yeah, they're going to go to 3%. Why? Because they're making 3%, 4% on their money that they've got invested or they're lending out. They're making a higher rate of return on their money because the Fed's raising rates. Therefore, they're going to pay you more. do you think that $50,000 that they're going to pay you $5, it's not worth it to make $1,000 of interest?
Well, and the other
I
thing
just-
is, if you're really stuck to your brick and mortar bank, you can still keep it. They make the process of transferring money back and forth extremely easy and very fast.
Yeah. And everybody says, well, I don't want an online bank because I can't go in and see the teller and stuff. But you know what? Most people are dealing with their brick and mortar bank electronically nowadays.
Right.
Most people are going in and doing bill pay and so forth. They're taking pictures of checks and depositing in their checking account. But like you say, what we say is you got a PNC or an M&T checking account or Bank of America, Wells Fargo, any of those types of brick and mortar banks, just connect your checking account to your online savings account and just move the money back and forth as you need it. And now you're always getting the maximum rate of return on your savings account. But if you're like me, Mike, and I'm an old guy, right? Look at my hair. I don't have any. And what I do have is white and black and, and so forth. I haven't had a brick and mortar bank relationship since 2006. I fired PNC. I have Schwab Investor Checking. I have Capital One 360 Savings, and the two are connected. And I haven't been in a bank branch in almost 18 years now, 14 years, whatever. What is it? It's 16 years, 16 years. So you don't need one anyway. But then the other one is it's tax time.
Right. Well, we're heading towards it. And, it's this time of the year when we want to start making those end of the year tax planning items. And Drew, you were saying that one of the things that's most important is that if clients out there are listening and they had some sort of an event that is, abnormal, not the same situation as every year.
And we don't know about it, right?
Right.
We can't plan around it until if you bring it into us next April and they say, wow, I got a really, really big bonus this year. And you're like, well, were you going to tell us? I can't do anything about it now. It's April. I need to know about it in October. And so if you've had a major financial event that could be taxable to you, a business sale, a bonus check that's abnormally high, something that brought more money in than you expected that could be taxable, we need to know about it now so we can do some estimated tax analysis, do some tax planning and so forth.
Yeah. Well, on the other side of it too, right, Drew? Because if they had exceptionally high medical bills for the year,
that's another good one.
Or deductible.
Or you did something very charitably, that we don't know about, that you gave something away to charity that's worth a lot of money. You're right. There could be big medical bills. Maybe you got a spouse that's in a long-term care facility, or maybe maybe your parents have some big medical bills that they're dealing with. And, maybe you're helping somebody in the family. There's things we can do. And at this time of year, Mike, we have a process that every planner gets every client they have to look at and see, are there qualified charitable distributions they could still do? Should they be doing Roth conversions? Should they be doing an estimated tax analysis? And so, we're doing the best we can to stay in touch with the clients and say, we think this might be good for you. But the client also has to help us and communicate to us that, can you help us look at this? Can you, I'd like to look at Roth conversion, make sure, and I want to, see why we should or shouldn't do one, qualified charitable distributions from IRAs for people over 70 and a half years of age. These are some of the things that a true professional comprehensive advisor should be doing for the fees that they charge. And most people who work with brokerage firms, insurance companies, or banks, all they're getting is their money invested. But this is what a true professional advisor should be doing, thinking these things out with the client.
Right.
Anything else you want to talk about, Mike?
No, I hope everyone has a great Halloween.
Well, that's true. That'll be the day before we release this, right?
No,
Maybe.
that'll be a month. That'll be at the end of the month that we
Oh,
release.
at the end, I was thinking,
Mhm.
you said that and I was thinking, wow, that is coming up in a day or two, but this is still September, Mike.
Correct.
No.
But this is
So,
our October update. That's when we
is
sent
that-
this.
well, my wife and I had a great 40th anniversary.
Yes,
That was
congratulations.
just a week ago, So
Congratulations.
anyway, Michael, we've got to wrap this up. We're probably longer than we should have been. This is Drew Tignanelli saying God bless.